Okay, well, I'll make it 10 o'clock on the dot. Good morning and welcome to our webinar. I'm delighted you could join us. As you can see, this webinar is all about reporting disposal of UK residential property. I'm delighted we're joined this morning by Nimesh, our Senior Tax Manager, and who's joined by his colleague Neil to present this morning. For those of you familiar with our webinars, you'll remember we always have a live Q&A at the end, and we intend to do that this time as well. So on your Zoom toolbar, you'll see the option for Q&A. That's your tool for putting any questions forward that you'd like to put to Nimesh or Neil at the end of the session today. We are also recording this webinar, so we will make an on-demand version available on the website later on today, just in case you need to recap over everything that we've talked about. Okay, so at this point, I will hand over to Nimesh, and I'll see you back at the end for our question session. So over to you.
Yep, thank you, Jo. Welcome, everyone. So we thought we would do a webinar on reporting residential property disposals because these rules came in last year, and we're finding that clients are selling properties but not fully aware of these reporting requirements. So since 6th of April 2020, there's been requirements to report capital gains made a lot earlier than before, and actually to pay taxes earlier than before as well. So in order to raise awareness and help individuals that are disposing of residential properties, we thought we would have this webinar so that we can increase the awareness and make more people fully prepared when they're actually making a sale, that they actually have this requirement potentially before they actually enter into the sale. So if we move on to the next slide, please. So what we want to do first of all is to talk about what the rules were in terms of reporting residential property disposals before 6th of April 2020. So if we move on to the next slide. So before the 6th of April 2020, if you sold a UK residential property, you could be liable for capital gains tax, both as a UK resident and a non-UK resident. For UK residents, the disposal was actually reported on a self-assessment tax return. And what that meant is that following a sale, a UK resident person, they could actually sell a residential property and actually not have to worry about reporting their disposal until they do their end of year tax return. And for non-UK residents, a few years ago, reporting requirements came in, so they actually had to report disposals within 30 days of completion of a sale. But now UK residents are now being brought in line with non-UK residents. So if you're a UK resident, you'll need to be aware of these reporting requirements, because you won't have as long as you may think, depending on whether your disposal meets the requirements to actually make a reporting requirement earlier. So, in the past, the deadline was actually the 31st of January following the tax year to report the disposal, because that was actually the deadline to submit the self-assessment tax return. So if you had sold a UK residential property, you'd have quite a long time to actually report the disposal and actually pay the tax as well, because that would have also been due on 31st of January following the tax year. So from a cash flow perspective, you would have had a lot more of an advantage, because you wouldn't have to fund the taxes so soon after selling a UK residential property. So move on to the next slide, please. So here we've got an example of an individual, a UK residential property was sold, and it was sold on the 1st of January 2018, and the gain made was, let's say, £50,000. So obviously this disposal took place before the 6th of April 2020, so the disposal would have been reported on the self-assessment tax return for the year ended 5th of April 2018. Now, as I mentioned earlier, the deadline for filing a tax return is 31st of January following the tax year. So this individual would have had until the 31st of January 19 to submit their tax return, which shows the capital gain made, and also have until 31st of January 19 to actually pay any capital gains tax, which would have been due on the disposal. So as you can see, quite a long time to get the information together, to actually fund the money for the taxes. So, you know, it was a lot easier and a lot more time was available. But obviously now things have changed after 6th of April 2020. So if we move on to the next slide. So we've got here changes for property disposals after 6th of April 2020. And first of all, we're looking at UK residents. So if you move on to the next slide, please. So a UK resident individual will only need to report and pay capital gains tax using HMRC's online service where there's actually a tax payable. So it's not applying to every disposal of UK residential properties. It's actually applying to scenarios where there's actually capital gains tax payable. So if you dispose of a property and there's no capital gains tax payable, then there's actually no need to inform HMRC of the disposal within the 30-day period after the completion date. And there's no need to actually have this additional filing requirement in addition to their usual self-assessment tax return. So here we're looking at individuals where there's actually capital gains tax payable. And later on, I'll explain what the requirements are, but we're just looking to see who's actually caught within this. So for example, if you lived in a property throughout the time you've owned the property, normally you can claim what's called main residence relief, which means that if you've lived in the property as your main residence throughout the time of owning the property, you're not actually liable to pay tax on the capital gain. And obviously in that scenario, you wouldn't need to do this additional reporting. So the kind of scenarios we're looking at here is disposals of buy-to-let properties, because those properties have been let as opposed to being lived in, or there may be situations where you've actually disposed of a UK residential property which you've lived in initially and then moved out, or there may be situations where you actually have more than one UK residential property available to you and to occupy, and this particular one may not be your main residence. So, you know, these are sorts of scenarios which we come across with clients and where we've had to actually do this additional reporting for them and actually calculate the capital gains tax, which is payable. So move on to the next slide, please. So here we've got a scenario where capital gains tax is not payable. So the gain made is actually under the annual exempt amount. So currently it's 12,300. So if you have actually made a gain and it's say £10,000, there wouldn't actually be any tax payable on that gain, which means you're not falling within this additional reporting requirement. And as I mentioned earlier, if you've lived in the property throughout the time you've owned it, you'll get full principal private residence relief. So that will mean there's no gain that's taxable because it's all exempt. So those individuals are not caught within these provisions. So next slide, please. So we've spoken about UK residents, but there are requirements for non-UK residents as well. So we'll briefly touch upon those now. So if an individual or a person is non-UK resident, then there are requirements to report and pay any capital gains tax for disposals of residential property in the UK, commercial property as well, any property which is a mixture of residential and commercial. So for example, you may have a shop with some flats above, and also assets where 75% of their value is derived from UK land and property. So as well as UK residents, you've also got non-UK residents that have reporting requirements. and they actually have reporting requirements, even where there's no tax due. So non-residents, they have to report regardless of whether there's a tax liability. UK residents only reporting if they do have a tax liability. So next slide, please. So as I mentioned, non-UK residents must report all disposals of UK land and property, even where there's a loss being made as well. So we talked about scenarios where there's no tax, where there's been a loss, that also has to be disclosed as well. So quite often we've come across non-UK resident clients where they've actually made a loss because of a fall in the property market in recent years, in the higher end of the market, but they still had to do this reporting, even if there's no tax due. So in addition, you've got non-UK resident trustees. So if property is held in a trust, you've got landlords. You've also got members of partnerships who are non-UK residents. If you're the personal representative of someone who's passed away, all these people would also fall within these requirements if there has been a disposal of UK land and property. So it's not limited to individuals. You've also got properties held in trust, properties held in the estate of a deceased individual. If there's disposals of properties, then these reporting requirements can actually apply to those people as well, or those persons rather. Next slide, please. So, as I mentioned, these requirements are not just for individuals. Properties held by trusts and in estates are also caught. So if you move on to the next slide. So if you are representing a trust, so such as a trustee, the trust must actually be registered with HMRC actually, in order to be able to file what we call the capital gains tax return. So the capital gains tax return is this additional reporting requirement. So what the trust will need to do is to actually provide its unique tax reference, the UTR, or its registration number with HMRC when they're actually creating their capital gains tax account. So if there's a trust that hasn't really had any UK reporting in the past, hasn't had any links with the UK in the past, besides holding UK property, if there's a disposal, then it will obviously trigger the requirement to do a capital gains tax return, and it will need to be done within 30 days of completion of the sale. But also, it will mean that the trust will need to actually do a formal registration with HMRC as well. So there'll be two aspects here. One is the registration with HMRC, and the second aspect is the registration for the capital gains tax account. So next slide, please. So with personal representatives, that these individuals that are personal representatives, they are responsible for the tax affairs of the estate. So they will be responsible for reporting the capital gains made on UK residential properties. So if the estate, for example, has various properties, and say in a few years after the person has passed away, the properties are still in the estate, and there's been a requirement to sell a property, perhaps to fund cash flow, then when that sale takes place, there'll be a requirement to file a capital gains tax return. If it's a UK resident person that's passed away, then there'll be a requirement to file a capital gains tax return if there's tax due. If it's a non-UK estate, then there'll be a requirement regardless of whether there's a gain or a loss. So there is that distinction there as well between UK residents and non-UK residents. Next slide, please. So I've spoken quite a lot about these reporting requirements, and you're probably wondering what they are. So, we spent quite a bit of time, clarifying who's actually falling within the scope of these requirements. So we've talked about UK residents with capital gains tax payable. We've talked about non-UK residents, regardless of whether there's capital gains tax payable. We've talked about trusts. We've talked about personal representatives. So we've got a clear picture as to who is potentially falling within the requirements. So let's now go into a bit more detail as to what the requirements are. So where there's a disposal that and it meets the requirements for this additional reporting, the disposal actually needs to be reported to HMRC within 30 days of when the sale completes. So if you sold a property and you completed on the 1st of March, you would need to disclose and report that disposal to HMRC by the end of March. So as you can see, there's not a lot of time between the completion of the sale and actually submitting what we call a capital gains tax return to HMRC within 30 days. So obviously it puts a lot of time pressure on clients because they've just completed a sale and all of a sudden they need to actually bring together their records so that a capital gains tax return can be prepared, and also we can actually calculate the capital gains tax as well, which might require historic information. So for example, there may have been expenses incurred on the property which have improved the property, which may have been incurred many years ago, and they can help to reduce the gain. So 30 days is not a long time. So that's why it's important for as many people as possible to be aware of this 30-day requirement before the sale completes. So they can approach us and we can actually go through the information we need beforehand. And potentially for some clients, what we do is actually do a provisional calculation. So we've gone through the historic information to calculate the gain, which we will then slightly adjust depending on the final figures on sale and the final cost of disposal. So as well as doing the capital gains tax return within 30 days of completion, the capital gains tax due is also got to be paid within 30 days of completion. So what we normally do for a client is to calculate the capital gains tax as well as doing the capital gains tax return. And for each client, it's very different because the history behind the property will be different. So the way to calculate the capital gains tax will differ on a client by client basis, because you might have some clients where they've never lived in the property, so the whole gain is taxable. You may have other clients where they've carried out works to a property, which is allowed as a deduction if it's an improvement. We may have clients that have lived in the property partly during the period of ownership and then moved out later on. So there are various different ways of calculating capital gains tax. So we will do that as well. And then in terms of the capital gains tax return itself, it's submitted electronically. So the registration, which my colleague Neil will talk about, takes place electronically, and also the actual return itself is actually completed electronically as well. However, there are circumstances where the individual or the person is not able to file electronically, and we have actually had some of these cases, and we have actually managed to allow or get HMRC to allow a paper return to be filed. So we could actually complete an actual form, physical form, and submit it to HMRC. But in the vast majority of cases, the expectation is that the return will be filed electronically. And the reason for that, obviously, is that HMRC can process that a lot more easily than a paper return. And also by filing the return electronically, it's received by HMRC immediately as well. So that helps with meeting the 30-day deadline as well. So next slide, please. So we may come across situations where the property is actually owned by more than one individual. So for example, it might be jointly owned by husband and wife, or it may be jointly owned between siblings or parents and child. where we have this situation, all the joint owners of the property will all need to file their own capital gains tax return. So what it means is that they all need to do a registration for capital gains tax online, and then they also need to file a capital gains tax return within 30 days of the sale completing. And all of this will apply on the basis that the requirements are met. So if we're talking about UK residents, they need to actually have a tax liability in order to be required to make a filing. But if it's a jointly owned property, it's not one return, it's actually one return per joint owner that's required, and a calculation of the taxes will be done for each joint owner as well. And on the disposal of the same property, the capital gains tax payable by each joint owner can differ. For example, one joint owner may have losses which they could offset because they made losses in the same tax year. They also may have losses brought forward from previous years, or they may actually be paying tax at a lower rate than the other joint owners. So that actually gives a proper reason for each joint owner to do their own capital gains tax return, because in many instances it can result in a different tax liability for each joint owner. So if the individual is currently in the UK self-assessment tax return system, then they still also need to report this disposal separately on a capital gains tax return. So there are situations where the person disposing of the property will have to do a capital gains tax return within 30 days of completion, but they still actually have to report the disposal on their end of year self-assessment tax return as well. So although the gain has actually been reported on a capital gains tax return, HMRC see this as a preliminary return, and the final reporting from a HMRC perspective still takes place on a UK self-assessment tax return. So the capital gains tax return is there to make HMRC aware that you've made the disposal and you've got tax to pay, but the UK self-assessment tax return is the finalisation. And there may be instances where you've reported a gain on the capital gains tax return, but the actual tax payable may differ by the end of a tax year, because let's just say, for example, during the beginning of a tax year, you've disposed of a property, made a gain. If later on in the tax year you've made losses on other assets, then those losses would need to be offset against the gain you made earlier. So that's why you would still need to do the UK self-assessment tax return, because the final position, the very final position, won't be known until you've done the final tax return. So we've actually got additional reporting requirements rather than a replacement of a reporting requirement. And the final bullet point on this slide is an interesting one. So in the past, if you don't normally do a self-assessment tax return, but you've made a one-off capital gain on a UK residential property, you would have had to register for self-assessment and do a tax return. Now, if this is a one-off requirement, what they're saying is that if you're doing the capital gains tax return and you don't normally do a self-assessment tax return, then it's not compulsory to do the self-assessment tax return at the end of a tax year. So there's not a mandatory requirement to register for the end of year self-assessment tax return just because you have a UK residential property disposal. You do have the option, if you don't normally do a tax return, you can just deal with it in the capital gains tax return. But like I said earlier, if it's found that the tax estimate on the capital gains tax return is too high, then you may want to do a self-assessment tax return to reduce the taxes. So I gave the example earlier. If the gain on the property is made early in the tax year and there's losses later on in the tax year, you may want to do a self-assessment tax return so you can benefit from those losses later on in the tax year. So next slide, please. So obviously I've spoken about the reporting requirements, who it applies to, what the reporting requirements are. Before you could actually do a capital gains tax return and submit it to HMRC, what HMRC expects the person to do is actually create what we call a Cgt account. So they're actually creating an online account with HMRC for the purpose of capital gains tax. So I've got my colleague Neil who will run through how that works.
Okay, so as Nimesh mentioned, HMRC are trying to put everything online these days. So the ideal scenario is to create a CGT account online if possible. So in order to be able to file a capital gains tax return online, you have to make a capital gains tax account. And this same account, it can be used for any future disposals. So just say you have multiple properties which you will be required to file returns for in the future. This same account will be usable for those future disposals. Next slide, please. So if the property is owned by more than one person, so just say it's a jointly owned property by two people, they would both be required to make a capital gains account. So it can't just be one person who does the account and files a return, two people will have to do it. And in exceptional circumstances, HMRC do allow a paper capital gains tax return, which I can explain in more detail later on. Next slide, please. So the first step in order to create an account would be to go to this link that is shown on the slide. Once you go on the link, you would have to press on the start button and you would then be asked to enter your government gateway login details. Next slide, please. So in order to be able to create an account, you would initially need to have a government gateway login. I guess many people would initially have a government gateway account set up, but if you don't, in that case, you would need to create a government gateway login. If you are doing this for the first time, it is a bit of a high security process, so HMRC would ask you to verify you through a text message or a voicemail. Next slide, please. So once you've been able to create the government gateway ID, you need to follow the process to create a CGT account. So the first thing HMRC asks is whether you have a national insurance number. Most people would have a national insurance number, obviously, unless you're a non-resident who's never lived or worked in the UK, in which case you wouldn't have one. If you do have a national insurance number, you would then need to enter your full name and your date of birth. Next slide, please. So this is where it can get quite challenging. So you need to answer security questions so that HMRC can verify your identity. So there are 3 tests. The first one is a passport, the second one is a credit history, and the third one is a P60 or payslip. And of these 3 tests, you need to have 2 options which you need to verify in order to create the account. So in some cases, you may not be working anymore, or you may not receive a private pension, in which case you wouldn't have a P60 or a payslip. And in that case, you would just have to have the passport or credit history. There are also some cases where some clients have had a passport that has been expired, in which case they're not able to create the account. So if that's the case, then you would have to do a paper return. So you would have to have at least 2 of the 3 options in order to make the account. So if you select credit history, it's also quite a lengthy process. HMRC asks various questions regarding your previous bank accounts, your mobile numbers, your credit card history. So if you are using that option, you should try to have those documents to hand when you're doing this, making the account. Next slide, please. So if you have been able to pass the security tests, you can then create the CGT account. It will be about a 15 to 16 digit number, which starts normally with XXCGT. And if you don't have an NI number, the process is actually quite easy to create the CGT account. All you basically have to do is enter your self-assessment UTR if you have one. If you don't have one, then you'll just need to enter your address basically and a few basic details. So it's a lot easier without an NI number, which wouldn't apply to most people. Next slide, please. Yeah, this is basically following on from what I previously said. So if you don't have an NI number, you would just basically have to enter your name and contact address, and then you can create the CGT account. Next slide, please. So interest and penalties. So basically, the penalties and interest are similar to what they are for the self-assessment tax return at the moment. So if you are not able to file this capital gains tax return within 30 days for any reason after the completion setting date, HMRC's standard position is to issue a minimum penalty of £100. There may be some flexibility on this at the moment because of COVID. It could be considered possibly to be a reasonable excuse, but that is their standard position. Daily penalties have been suspended for returns that are filed over 3 months late. So for tax returns, there are normally daily penalties when it's normally filed over 3 months late. And this would normally be £10 a day with the total daily penalties capped at £900. And if the return is filed between 6 to 12 months late, the penalty would be the higher of 5% of the liability or £300. So just say your liability is £10,000, 5% of that would be £500. So it could end up being quite a steep liability if you are unaware of the current requirements and you fall within 6 to 12 months late of the filing date. Next slide, please. The interest that is charged would be 2.6% per annum. This obviously is non-negotiable with HMRC. So if you are late for any reason in filing the return, there will be 2.6% per annum charged as interest, and that can't be appealed with HMRC. Next slide, please. And yeah, if there are any questions, please feel free to ask.
That's great. Well, thank you very much, Neil and Nimesh, for that. I have got a couple of questions in, which I'd just like to put forward. I'm not sure who's going to answer them, so I'll put them forward to both of you. The first one has come in from James. A property I lived in, I've moved out of, and I've now let it out. What's the tax implications if I sell that? You're on mute, Nimesh.
If you've lived in a property and you subsequently moved out, so what it will mean is that part of your capital gain made would be taxable. So if you've made a gain overall and you're a UK resident person, then you would actually fall within the requirements to file a capital gains tax return. So say, for example, you made a gain of 100,000 on a property and you lived in the property, say, half the time you've owned it, half the gain would be taxable. In addition, you are treated as living in the property for the last 9 months of owning the property as well. So you can claim an additional deduction based on an extra 9 months of living in the property. So if you've had a property for 10 years and you've lived in it for the first 5 years, you're deemed to have lived in it for the first 5 years plus another 9 months at the end, even though you weren't there. So if you take 5 years and 9 months over 10 years, that fraction of the gain wouldn't be taxable. The rest of it would. So you would still fall within these requirements to file a capital gains tax return, and the tax would also need to be paid within 30 days. But obviously, having lived in the property for such a high proportion of the time in that example, the taxes should be significantly reduced compared with a person who never lived in the property.
Okay, got a question here from Alfred. Thank you, Alfred. Reporting is based on completion, but CGT is based on exchange date. If consideration prior to completion is over 18 months, reporting is later, but tax is due with possible relief for instalments. Do you agree?
If the capital gains tax does qualify for the instalment arrangement, then that can be applied for. So the 30-day deadline is a what we call a general deadline. So for example, it used to be 31st of January following the tax year. So that particular deadline has been replaced by this deadline of 30 days from completion. But there are certain circumstances where the capital gains tax can be paid in instalments, and it's usually when the proceeds of a sale are received in instalments, so you haven't actually got all the money from the sale. So yes, the rules on paying capital gains tax in instalments, they still exist. and that can be applied for at a time. But in terms of UK residential property sales, they're not as common compared with, say, sale of shares in a business, where quite often the proceeds are received in instalments. But yeah, the instalment arrangement that still applies; those will still exist.
Okay. Another question here. Just to clarify, if the gain is under allowance and no CGT payable, there's no need to report. But if it's jointly held and say one person's gain is under and the other over, so tax is due, do they still both need to report, or only the one with the tax liability?
I'll assume they're UK resident individuals. If
Yeah.
they are, then it'll be the one that has the tax liability. So the tax return is done on an individual basis, not on a joint basis. So if one individual doesn't have a tax liability, they're not required to file. But if the other joint owner does have a tax liability and they're UK resident, then they are required to file.
Okay. And a follow-on from Alfred, who said, thank you for answering that first question, but is overseas residential property out of scope for the 30-day reporting?
Yes, it is out of scope. So these rules apply to UK land and property. So for the UK resident individual, the requirements apply to UK residential properties.
Mm-hmm.
And for non-UK resident individuals, the rules apply to all UK land and property. So overseas properties are not within the scope of what we're talking about here. So if you have a UK resident and they sold an overseas property, then you're only reporting it through the usual self-assessment tax return and paying any capital gains tax on 31st of January.
Okay.
The tax year.
And a question here about computer literacy. So if I'm not that computer literate, can I get help to create this account?
Neil, do you want to handle that one?
Yeah, sure. So as I mentioned before, it is possible to do a paper to capital savings tax return. If you are really struggling, as in you're not able to answer 2 of the 3 security questions, in that case, you can call the self-assessment helpline, which is 0300-200-3310. And HMRC would send out a paper tax CGT return to you, which you would then just have to file as a paper return. But the deadline still applies, the 30-day deadline still applies.
Lovely. Okay, well, thank you very much. Okay, well, that brings us to the end of our webinar this morning. A big thank you to Neil and Nimesh for your contribution this morning. As I mentioned to everybody at the start, this is being recorded, so we will make a recording of this available on our website later today. And of course, if you've got any further questions following on, don't hesitate to contact Neil or Nimesh directly. Their details are all on the website. Okay, thanks very much. See you at our next one, hopefully.